Hello, this is Edmund Shing from BCS Asset Management. This week we're looking at the global currency war, who wins and what effect does this have on the global equity market. So to summarise, we think that, we can see that emerging market currencies have reversed course and are now depreciating rather quickly. More importantly, even the Chinese yuan is no longer a one-way strengthening bet, with, in contrast, the G10 currencies such as the US dollar and the euro taking the strain and strengthening on the other side of the equation. We will then look at what effect this has on bond markets and equity markets as well. So if we start on the big reversal in emerging market currency trends. Here we can see that the Turkish lira has been the first currency to depreciate following the problems we've seen in Turkey, particularly focused around bank credit, the high level of bank credit and the deteriorating current account. This has then been followed, of course, by depreciation in a sharp sense for the Russian ruble, really since the end of December, moving from 32.5 rubles to the dollar now to over 36. And even elsewhere in the emerging markets, the Chinese renminbi or yuan, which has been seen for a long time as a one-way strengthening bet against the dollar, has again broken out of that strengthening trend and has been weakening sharply really in the month of February, so over the last 4 weeks or so. So really we have seen big shifts in emerging market currencies to weakening. And on the other side, well, what we should note though is that even though if you look at the black line on this chart on page 7, yes, the Chinese yuan is weakening. You can see that right down in the corner here, but only after a huge trend of strengthening which has been in place since the middle of 2005. So really, you should, keeping things in context, there has been a big move in favour of emerging markets for the last few years, and only now, more recently, has this been reversing. Taking the strain has been the US dollar, here on page 8. The black line, you can see here, has steadily strengthened over the last few months and is approaching a new high. The same can be said, of course, of the euro on a trade-weighted basis again. You've had a strengthening trend in the euro against other currencies, really for a whole year. And again, we're not far from the recent high. So it's clear that the US dollar and the euro have been strengthening, while other emerging market currencies on the other side of the coin have been weakening. Now, what effect has this had on other asset classes? Well, firstly, you can see here on page 11 that Eurozone government bonds, the yield having gone up previously last year, has been coming down quite sharply over the last 2 months. And this is definitely a move to safe haven, a move into the euro, and also a move into euro government bonds, because people see that they are less likely to see yields rising than, for instance, in the US. However, when we look at macro volatility, and this chart on page 12 is a chart of the Citigroup, you can see down here the Citigroup Macro Risk Index, we can see that despite all the problems around emerging markets in Turkey and more latterly Russia and Ukraine, nevertheless, this macro risk index is still below its 2013 average. So no obvious signs of stress within financial markets, according to this index. And if we look on page 13 here at midterm implied volatility for the European stock market, it has been grinding lower over the last 3 years. And even in the shorter term, over the last few months, again, the trend is down. So stock market volatility has not really been rising. In fact, if you look at the longer term, it has been falling and continues to fall despite the issues we have in emerging markets today. In terms of performance, here on page 14, we can see that whether you look at this black line or the green line, when we're looking at peripheral countries such as Italy and Ireland, we have seen strong outperformance over the last few months versus the Euro Stoxx 50 benchmark index. So the peripheral economies within Europe have been favoured, and these are higher risk, of course. So that suggests that clients prefer higher risk to lower risk right now, despite again what is happening with emerging market currencies. And finally, Asian stock markets. Well, here we have three. We have Japan in black, we have India in red, and we have Chinese stocks in Hong Kong in yellow. But in all three cases, what is interesting is they have been rising all through the month of February. Again, despite the risks seen from emerging markets, these three Asian indices are actually gaining ground. And that to me is quite encouraging. The final point I would make is really looking at emerging market bonds. Now, I think emerging market sovereign bonds could be a quite interesting play right now. Here we have Eurozone bond index, which has of course gained 2% over the last 2 months. At the same time, we have seen really since the middle of 2013 a huge drop in the value of emerging market sovereign bonds. This is an ETF of emerging market sovereign bonds priced in sterling. Now here we can see a big drop, and I think this could be a value opportunity. It looks like it's bottomed here. You're getting a current yield on this ETF of 5.7%, which is very close to what you get from US junk bonds right now. So to summarize, I actually think that the recent trend of depreciation in EM currencies could revert to mean what is just a reversion to mean from the long-term strengthening trend. I think this means, with strengthening euro and dollar, that the Fed and the ECB will be on hold for longer. And I see no real damage to stock markets, and note that stock markets such as the US and Europe are actually breaking new highs right now. The value play, of course, could be emerging market sovereign bonds priced in local currencies, and you can buy these through exchange traded funds, for instance. This is Edmund Shing from BCS Asset Management saying goodbye.